We call it scalping the open with options. Now the opening period is from 9:30 till about 11 o'clock, sometimes 11:30. So we'll go ahead and talk about that process and why we like to and enjoy doing that. So we'll go ahead and see how it goes as we go along with the program here. Let me just see here. All right, now there are a lot of people in the room tonight, and there are a lot of questions coming through. So if at times I stop, I pause, I'm reading the questions, making sure I try to answer the questions as they come in. However, just to make things flow a little bit more smoothly in the tonight's session, I may pause from reading the questions and then go back to make sure I have everybody answered. Because sometimes your question, because you guys are paying really good attention, sometimes your questions will come up before I can answer them, which would be maybe in the next slide or two. So we'll go ahead and continue with that. Okay? All right, let me go ahead and get started here. And okay. All right. Again, those of you that are familiar with the room know that you could submit your question via the side menu of GoToWebinar, and I will see it as soon as you type it. All right. This is our risk disclaimer. We at MicroQuant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Okay, you guys can hear me okay? Thomas, you might want to double check this. Double check your sound. Yep. Sorry about that, Sam. We were that was over in the futures room. Yep. Okay. All right. Again, this content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making investment decisions. Now, we're taking reasonable measures to ensure the accuracy of this information, but we can't guarantee its accuracy or is not liable for any loss or damage which may result directly or indirectly from such content, from an inability to access such information, or failure of the transmission or receipt of any instruction or notification in connection herewith. Now, past performance results are shown for illustration and example only. They are hypothetical and as such have many inherent limitations. And no representation is being made that any account will or is likely to achieve profits or losses similar to those shown. And most important here, past performance is not necessarily indicative of future results. Okay, this is CFTC Rule 4.41. This is a U.S. government required disclaimer. Now, the CFTC wants you to know that futures and options trading not only has large potential rewards, but also carries large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Now, don't trade with any money that you cannot afford to lose. This is neither a solicitation nor an offer to buy or sell futures, stocks, options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown as discussed on this website. Now again, past performance results of any trading system or methodology is not necessarily indicative of this results. Now if you have any questions on either of these two disclaimers, feel free to go ahead and contact us at MicroQuant. All right, so okay, now we can get to moving on to the topic of tonight's webinar, scalping the open with options. Now, what do we mean by trading the opening of the market? Or what is that? I mean, I've kind of alluded to it earlier in my introduction, but just give me a try here. Why would you want to trade the option? How should I go about it? Anybody want to type anything in there? Just give it a try. Why should this period of time interest me? What advantages do we have? Leverage, gaps. I like gaps. Volatility. Okay, a lot of trading activity. They're very good. Movement, lots of stock movement, big movement, momentum. Fast and furious, higher volatility, volume, good. Well, you guys have been around long enough that all those answers sound good to me. But the problem is most retail traders don't realize that. This is how we usually refer to them as amateurs, because they kind of are easily swayed by the opinions of the financial news and their friends and things like that. That's what we refer to as amateurs. This is how they view the market: wide open, great opportunity, beautiful land, seascape. But this is the really way they should see it. Okay, there are big predators that lurk in those kind of wide, beautiful spaces known as the market. Okay. There's a Wall Street saying that says amateurs open the markets and professionals close them. You take a look at the normal daily activity bar, and usually the open and the close are at the opposite ends of the bar. You can see that here. See right here, you see, oops, let me get my pen. There we go. You can see this is the open right here, and this is the close right here. Opposite ends of the bar, and it's usually the case. Okay. All right. 1 second, please. Okay. Okay. All right, so the opening of the market can provide a clear view of the imbalance in the buy and sell orders, okay? Because there are pre-market orders going in and trading, but the vast majority of retail trading occurs when the market opens. Okay, now market makers can open the prices higher when there are more buy orders, and conversely, they can open prices lower when there are more sell orders. Okay, you always wonder why is that discrepancy. So basically, when imbalances occur, prices usually move back towards that gap, and market makers balance their accounts, and then they pull in a profit when these gaps fill. Now, most institutions, the big guys out there that run either hedge funds or big mutual funds, they don't trade that right there at the open, right at the gap. They never go in with market orders right there because they want that gap to fill before entering new orders. Now, the smart money is waiting until the amateurs get eaten up first. Okay, here's a good example of that situation right there. That the amateurs are all swimming around in the volatility and the churn of the very opening prices, and the big guys come along and take a little fish, zip in, zip out, and then eventually all the retail traders get swallowed up, take advantage of. Okay, so now we don't want to be a little fish. We'd rather be one of those bigger guys that come in and take advantage of the opening and take advantage of the situation created by the retail trader. So the question again is, how do we take advantage of this opening? Basically, there are three types of moves that we do in the options and stocks live trading room. We try to fade the opening move. This is probably the most risky, but sometimes it's also the fastest moving move. And then we look for a gap fill of the opening. All right, those two are very similar, the first two, but one is a more complete fill, either complete fill or maybe a 50% fill. And then after that initial flurry of activity, but still within the first trading hour or so, we're looking for divergences on the second or third moves, higher or lower. There's a lot of opportunities on active days, and lots of times we look for a particular setup known as price and momentum divergences. And I'll go into that. Okay. Why don't I do this before I touch on on that next slide? I want to see if there's any questions. Paul, his question is, what's the reason why I see a typical change at 10 a.m.? Well, Paul, it doesn't always happen at 10 a.m., but it's initially occurs after the first flurry of activity. It depends on the day. Sometimes that flurry of activity can last, 5 minutes. Sometimes it can last all 20 minutes. But usually that 10 a.m. hour, sometimes 10:15, the time period right there, that's usually when there could be a reversal in the overall market. We don't necessarily try to, in our trading room, we don't necessarily try to stick to, well, historically, 10 minutes after 10 is when the market starts to reverse and go in the opposite direction. When you try to make a blanket statement like that, it makes it difficult because it's something that you're expecting but that may not come. What we try to do in the room is be aware of the possibility of that kind of move, and then we will look at it and then trade what we see. We don't necessarily look for a particular move and then trade that. We watch for the move and then we trade it. It's a little different, but how do I find stocks that gap up? Oh, that's a good question, John. I mean, the way we technically play it in the room is a little differently. We don't have a list of, say, 100 stocks that we look at for it to gap up, because the traditional stock, the one that may have less option activity, technically when they gap, they stay up. So the question is you should, in order to profit from a stock that gaps right at the open, you really should be in that stock before it gaps. And you don't really have a way of knowing that, oh, this stock tomorrow morning will gap up. If I knew that, that's all I would trade, because I can't, you don't know what's going to happen in the overnight period. So, but I'll show you some setups, and I think you'll be well pleased with them. Okay, so but before just getting into that, so you'll be able to read the charts well. Let me first touch on, for those of you that are not familiar with value charts and the way the indicators that we use, we talk about. When we talk about technical analysis, we talk about it from the point of view of 3 different components. The ones that you're most familiar with is price, okay? That's not a problem, the price of the stock. And then we talk about momentum. Okay, this is something you may not be very familiar with. I see the price and I see the price changing. The momentum reflects the change and the rate of change in that price, okay, and which direction is it going. And the third component, unless you're very familiar with value charts, don't normally understand the definition of of value, and the idea of unbiased evaluation of value based on previous past prices. I'll go into that so you can see it now. Now, again, these are the tools that we use: open, high, low, close bar charts, value charts, and value bars. For momentum, we use our momentum indicator known as MQ momentum, and this other one known as the squeeze indicator. Momentum is also MACD is another one that you may be familiar with. Okay, and then last but not least, trend identification. We use MQ regression and MQ trend, both indicators in our MQ momentum indicator suite. Okay, the indicators and their settings. For those of you that are familiar with these indicators, these are the settings that I use. And typically I trade the opening with tick charts. You're very familiar with minute, a 5-minute chart, a 2-minute chart, a 1-minute chart. I use specifically tick charts, and they're based on a certain number of transactions. Yes, this webinar is being recorded right now. All right. Now, typically, when you say value in the financial industry, what we're normally talking about in the financial news is a subjective opinion as to if a stock is under or overvalued. You're probably more familiar with a value mutual fund. But you have to keep in mind that is subjected to the opinions of an analyst or a group of stock fund managers, and it's their opinion based on the analysis of the company documents as to what the profitability may be. But in all cases, that is subject to an individual's or a group of individuals' subjective determination of value. When we talk about value, we look at it from like an empirical, objective valuation of the current price based on the real past prices within an analysis period. Okay, so we actually have a look back period in which we compare the current price to the historical past prices, and that allows us to know where that current price falls within a particular range. And you can see that those ranges are outlined in these 5 color-coded areas. There are 5 primary value zones. Now, the first zone is this green center zone, also known as fair value. Above and below that are these yellow valuation zones. These are moderately overvalued and moderately undervalued. Above and below that, we have significantly overvalued and significantly undervalued. Okay? Now historically, prices are contained within fair value roughly 66% of the time. Okay? In the yellow overvalued and yellow undervalued levels, we're roughly in and out of these areas roughly 16% of the time. Okay, and above and below those levels, anywhere from roughly 1 to 2.5% of the time. Okay, combined. Now this is combined. It's not 1 and 2.5% of the time. So as you can see, it might vary very slightly depending on the market we're talking about, but roughly, prices want to stay in the green fair value zone. And then every once in a while, they'll stray out into these moderately and significantly over and undervalued zones. Okay? Now, the way we're going to represent price are these traditional open, high, low, close bar charts. Very simple. This is the opening side. This is the close on this side. This is the highest point, highest price paid on that bar, and this is the lowest price paid on that bar. And here's the line that connects the two. Okay? All right. Now, historically, price open, high, low, close bar chart, price charts are very good representing price over time. Now, when we combine this value charts indicator with the current price chart, you can see that prices in this area correspond to these significantly overvalued levels. Prices down here correspond to the significantly undervalued levels. Prices in here are moderately undervalued. And this prices in this central zone right in here represent prices in the fair valued area. Okay? Now, what happens is when we're trying to watch price and value at the same time, it's hard, especially in fast-moving markets, to see both price and value at the same time. Sorry, Dave. Hopefully that's a little bit better. Okay? So what we've done is actually combined it all on one price chart. You still see the open and you still see the close, but you also see very easily reflected as prices move up and down within this bar where the valuation zones are. See, significantly overvalued, significantly overvalued here, significantly undervalued, and significantly, moderately overvalued. Here's significantly undervalued. Here's moderately undervalued, and here's fair value. Okay. Now, again, these prices are relative to the historical analysis period, but they provide us with a good opportunity to see both where the current price is sitting within the 5 primary valuation zones, as well as we can see their traditional price action and how it moves up and down within the price spectrum. Okay. Any questions on that? Russ, that's a good question. Okay, let me answer that first. How many periods is in the look back period? It depends on the setting. Usually I run, I usually run about a 20 period look. I believe it's 20 period. I'm sorry. Bear with me. I've set it and I don't use, oh, I'm sorry, the 5-bar analysis period, because when I'm trading with ticks, I tend to use a shorter analysis period because I would like for it to be adapting faster and getting more colors in there as we're trading higher and lower. Okay, if you have a longer time frame and tend to want just picking out some of the more extreme areas, then it's better to go with a little bit longer look back period. It can go anywhere from a high of 50 down to 5. Okay, so the middle range in there is good. All right, now the other two that I want to quick touch on are MQ regression and MQ trend. Now MQ regression, this is this red line here, and it turns to green. This is a non-specific, it's not like a moving average. It's not price specific as it's charted on this chart. The main information that we're getting from MQ regression is when the line is red, the trend is bearish. Okay? When the line is green, the trend is bullish. The one thing that I do glean from this is I look at the slope of this line. The steeper the slope, the stronger the trend. And when the slope of this line tends to flatten out, there's an opportunity when it goes to 0 and then it changes in the opposite direction, it will change the color of the MQ regression line. Okay? So it's easily seen that in this period right in here, you see when we're going from red to green to red to green, there's a transition, there's a turn, and usually that's reflected in the price chart also. Okay, this just tends to lag a little bit. And then these are our MQ trend dots right here. They also define the trend. When they're red, then the trend is technically still down. When the dots turn green, the trend is up. If you're using some trend following techniques, usually you wait for both to be in agreement, then you'll ride that trend. But I actually use it in the way I trade as a parabolic SAR, and actually they provide me pretty good points that reflect the support and resistance level, and also as targets. If I'm going long here, that's a reasonable target. We're going to stop there and then fall back. Same thing here, prices are falling. Okay, right here when we first touch the MQ trend dots, they find some support there, and occasionally we break through and continue. But the type of trading we do tends to be a little bit shorter term, and at least we know that this is a level of support, or here a level of resistance. Okay, that we actually have to break through before we can continue. But I'll get into that also. No, Tony, the MQ trend is behaving like a parabolic SAR indicator. All right, now this is the next indicator that I use on every single one of my charts. This is our value chart's MQ momentum indicator. This is the primary momentum indicator that I use. Okay, it's comprised of this one solid line, and then that is our indicator line, and then the next is this dotted line, which is a slow line. Now when the fast line is below the slow line, the histogram bars are represented in red. Okay, and this is a bearish situation. Usually when you see that, prices are falling. The higher the histogram bar, the faster the price is falling, because the difference between the fast and the slow is wider. Now when we cross, that is right here when you see the histograms go from red to green. And then at that point, it's a transition point. The fast line is now above the slow line. And when that happens, the histogram is both positive and green, and prices are bullish. Okay? Again, we use this in the room primarily as a determinant to measure the strength of the move, the price action move, and then use it to compare previous moves with the current move to see if we get a price momentum divergence. It's very similar to an MACD indicator, except Mark Helwig developed it. He's the founder of Microquant and Value Charts, the creator of the Value Charts value system, and it's a hybrid of different variables in the MACD type indicators, combined it into this one. And but if you don't have value charts, MACD is something you can also use too. Is it different than a squeeze indicator? Yes, Arthur. It really is. It is really something completely different. A squeeze indicator is basically using Keltner channels and Bollinger Bands, and when one is within the other, that's and it's quiet. That's when the squeeze is basically on. Pete, I guess you could do that. Yeah, if you set the numerical settings to MACD to match it exactly, then it might work. I can't attest to that. I know the algorithm is different. Okay? All right. Let's go ahead and continue. So now that we know the technical indicators that we're using, let's talk about the three types of trades we're going to do. Fading the opening move. 2, looking for a gap fill. And then 3, divergences. Okay? Let me just make sure no one has any questions here. Rodney, I wouldn't know. I'm not familiar with that true strength index. That's good, Henry. Gap up, gap down. I know a lot of people, I can touch on this later, about gaps. And like I said at the open, gaps are nice because you can see them there. And gaps are caused by maybe either a news story or an earnings story, something that rapidly changes what people would consider as a rational value of the underlying stock, maybe in an overnight or early in the morning, and then it causes a difference in where the price closed and where people are willing to buy it the next day. Now, most people look at that and they say, okay, I'm going to buy that. That's strong. And I'll show you as we're trading, that may not always be the best idea. Sometimes it can work out. And then sometimes you try it and it doesn't do anything for you either. Okay, well, I'll touch on that. But the question is how would you trade a gap if you're not in the trade already before the gap happens? This is a very simple question. Because you didn't have any indication the night before or right before the close the previous day that, hey, this stock's going to gap one way or the other, because that'd be like shooting fish in a barrel. Like, oh, it's going to gap up. Then I'm going to I'll buy calls and then sell them first thing in the morning. But that's again, I mean, most people will tell me, hey, Dave, such and such stock is gapping up 5%. And I'll go, that's great. But I'm not in the trade. So, All right, well, we'll talk about pre-market. Well, pre-market, if there's a gap, it doesn't mean they're going to sell it to you at the lower price. Okay, the gap's already there, pre-market or at the open. The only difference between pre-market and after the open is the amount of volume. and the fact it may move more. Okay, we'll talk about that in a little bit. All right. John, I like your answer. Look for a half for gap fill. All right, so basically how we're going to be doing these particular trades is kind of the regular way we do it in the options trading room, is we buy directional calls and puts. These are utilization, and these are intraday trades. So we're using calls and puts as a surrogate for the underlying stock. I mean, I could go and buy Apple at $508 a share, and basically for 100 shares, I can, what would that be? $50,800. I could lay out $50,000, or I can step in and buy a $10 call, which will cost me $1,000. So 50 versus 1,000. If I think Apple's going up, it's better for me to leverage-wise to just put out $1,000, not 50,000. Okay, so but we're using it as a surrogate to buy directional calls and puts. Now, the question is I utilize in my room the in-the-money weekly options, okay, the ones that expire on Friday. Okay, if it's Wednesday, looking at the ones that expire on Friday. I buy Delta 70 or better, okay? The main reason is that is the best balance between leverage and being able to take advantage of movement in the underlying, okay? If the stock is going to gap down, I'm looking to buy calls if I'm going to try, if I think the stock is going to fill that gap, right? If it gaps up, I'm actually looking to buy puts because I feel the gap is going to fill to the downside. Okay, again, in the money Delta 70 puts. All right, now why use options? I think we kind of talked about it already. Leverage. Do I want to spend $50,000 on 100 shares of the stock, or do I want to spend $1,000 on one contract and it controls the same 100 shares of stock? Now, which stocks? Now, this is kind of important too. I mean, everybody in the room know I have a defined list of about 20 stocks that I, quote, look to trade. But the reason is, and again, this is you can't just say, hey, there's options on this stock, this is great to trade. And I'm the first one to tell you that's a very bad idea, because if it's the opposite of all these 4 points that I'm going to tell you, it's going to be tricky to trade it. Okay, at least definitely on an intraday basis, and even longer depending on the characteristics of the stock. But the stocks that I like to trade are ones with high options volume and liquidity. All right, I want to also have high options trading volume. Okay, I mean, basically high volume on this underlying stock. I think I mistyped that. High volume on the trading stock, so it's moving. And I want the stock to be large in price. I'll show you why. Big stocks move big amounts within the day, and it's reflected in a large average true range. I don't want to necessarily trade a $20 stock, okay, and watch it move 10, 15 cents in the opening period. I'd much rather trade something like Google that's $1,135, and I want to see it move $2, $3, $4, $5, $7, $8, $10 when it makes a move. It's easier to make money that way. MasterCard is also another one. MA. Well, honestly it was better before when it was $700. Now it's $73, so it gets a little tricky now. All right, these are the examples that I have. I'm going to put them out here. Apple, Google, Amazon, Tesla, Priceline, Netflix, CMG. All those are good stocks to trade. Okay, and some of them, even intraday, are a little tricky, but they do have opportunities. All right, let me go ahead and walk through some of the trades and the chart examples, and then we can take it from there. Okay. All right, here's the first example, and this is basically what we're doing is fading the opening move. Please excuse, this is probably a little bit older. Well, actually not, because Apple closed at 508, and this is going back a little bit. But anyway, this is where it closed, right down here, right around 515. Okay, we gap up roughly $3. Okay, and what happens is we see there's initial down pull here, and this is a 250 tick bar chart. Okay, now I know you guys probably that haven't seen this before may have some questions, but just bear with me. Okay, prices continue back higher after the gap, and everybody that bought right here is smiling and tapping themselves on the shoulder. Now as we're watching it, we're actually looking for this initial move to weaken. Okay, and we can see that's reflected in MQ momentum. Here's the apex right here. We hit moderately overvalued here, and at this point we can actually consider hold on one second. I want to just erase the ink here. You can see at this point right here, you see how MQ momentum stops going up and it starts to flatten and then start to go down. See how the histogram bars are gradually getting weaker and falling. Okay, right at this point, moderately overvalued. Again, we're using value to help us time our entry in, and at this bar right here, we start to weaken. So all those items lend to the fact that now or very soon we're preparing to buy what? It gaps up. So we think the move is going to be down. We're buying Delta 70 puts or better in Apple. And as we'll try to get in here moderately overvalued, prices fall. This point right here, this is a value range trade. I buy it yellow, I sell it yellow. I can, if I have two contracts, I buy them here, I sell one here. We have a little bit of a bounce, but MQ momentum's indicator line is still going down. It still has a negative slope right here, and here's still a negative slope. Histogram bars are still red and falling, so that we can hold that other contract. And right here, this is about even to this level here where we just opened. So we're fading this initial move here, and then we see the indicator, our indicator line here on MQ momentum go flat and start to actually increase. And once that happens, and also you can see the histogram bar starts to get shorter. Once that happens, we'll get out here. Okay, this move from roughly 518.75 down to here, 516.75. It's anywhere from $1.50 to $2 move. Now remember, this is a Delta 70 move, so the option that I bought, the Delta 70 puts, cost me around anywhere between $9 and $11. This move right here of about $2 down earns me about $1.50 a contract. Okay, so that's roughly $150 a contract, and so it's $1.50 divided by roughly 10, so that's about a 15% profit right there from this point to this point. So you buy it for $1,000, you come down here, you sell it for $1,150. Okay, one contract, one move, and this probably occurred within the first 5 minutes, and it probably took about anywhere from 7 to 10 minutes to move. And we find this again, this move shows up many times when we trade. I mean, I've been trading this particular type of trade for 8-9 months, and it's almost there all the time. Not necessarily the fade, but these opening moves. What's the time between the bars? It's a tick chart, John. So it just depends. If there's heavy trading at the open, this is moving kind of quickly. This from one bar to the other could be 3-4 seconds. It could be something slower later in the day. Okay. So right here, $150 a contract. Not bad. It's about anywhere from a 10 to a 15% return on your money. The next one, this is the Google 75 tick bar chart. Now this is the next kind of trade, a gap fill trade. So here, Google, We close here, we open down here. Now here's MQ trend right here. See the dots? Right here. So when we open, we basically are flat right here, right on support. We touched it, touched it, touched it, touched it, touched it. We push down through it, but we always close the bar above it. Now if I'm watching momentum, it's negative, and then it goes flat, and then it starts to increase. When I see that, and I see that the price is not yet moving, then I will, especially when I'm a support like this, then I'll look to get in. Now I'll tell you, when this bar right here closes on the squeeze, it's actually going up. Okay, the slope is going up. I know it's still red, but it's changing the slope. It's starting to go higher. Momentum is going higher. Okay, that's when I'll buy right in here on this bar. And this is, again, this is Google. This is a very good example of buying calls and holding them. See, the gap is only this far, and what we do, we shoot right through that gap and continue higher. Okay, that as long as the slope of this indicator line here is positive, we'll hold it and we'll continue higher. One Delta 7D put in Google, it's a little different. It usually runs about $15 because it's a bigger stock, etc. But you can see the movement in the underlying right here is $9 to $10 from where we could get in to where we could get out up here. $9 to $10. Now, if this is a Delta 70 option, we can estimate that we made probably $8 on the option, and it's a $15 option. So that's roughly, what, 45% on our money with that particular move. That is roughly an $800 per contract move. Again, that's why I love to trade Google. Sometimes it's a little rough because of the height of these bars, but you can make some serious money if you can catch a move. You probably trade this with fewer contracts than you would, say, something like Apple. Okay? Do I keep track of different strategies? Divergence trade, fading gaps, red snapback? Naga, I do, but there's not that many types that I try to trade. It's just you'd overload if you tried to do too many. Let me see if there's some more questions. Can Google be traded successfully on tosses 133 tick? Yes, it can. It's just a little slower, James. That's all. I mean, if this is a 75 tick bar chart, then basically I'm combining two of these each time, and I would have 3 bars, and then it would start to move. 2 contracts, 2 times, yeah. Do you have a stop on this trade? Well, you can see right here, John, that down here, hold on. I'm going to erase. Where's, I did already mention this is this right here is a support level that I see Google bouncing on. Now here are the lows right down here. I think a reasonable stop would be if I think this is going to go up and momentum is going up and this somehow flips over and breaks through this level right here, that's a reasonable stop. Why? Because in order to get down here, my premise of my trade is gonna be broken. This momentum indicator line will probably be negative. Okay, then I'm out of the trade because I'm looking for it to fill the gap. If it goes the opposite way, it's not filling. But what you got to be flexible, because if you see that and then you see it moving down, well, you could actually get a bullish divergence. It depends on how strong that downside move is. Okay, let me see. Let's see here. What percentage of your trades are profitable? Tom, I'm going to save that one for the last. Okay. If you ask me that question, if I don't touch on it before we leave, I'll let you know. But I'll tell you, people in my room know that I'm very, very consistent and profitable. Yeah, very. So it depends on the type. But when we're trading intraday, it's very, very consistent. Okay, the question is, I noticed that you look at the NASDAQ and go in its same direction. Does the NASDAQ have to do? Yes, Jonathan. Someone from my trading room asked me the question. of this move right here probably coincided with an up move in the NASDAQ. I watch the NASDAQ on a 30-second chart. And if there's a strong move in my direction, if momentum is in the NASDAQ is going up, there's a very good chance that this stock is going to go up. If the NASDAQ is falling hard, I'm not looking to be bullish. Okay, the way I paraphrase that with the people in my room is that the market is the tide of the ocean. Okay, Google is its own little boat with its own power. Now, if I want my boat to go up, I want it to go out with the, I want it to go up with the tide. Okay, I know in and out is what tides do, but I'm trying to give you an example. Okay, if the tide is going up, then my boat has less difficulty going up. I look for the setup first, and then I look for, well, and I also look for the move. But if I see the NASDAQ making a strong move in one direction or the other, then I'm actually looking at my trading stocks and seeing if I have any opportunities to go that way. Okay. If the NASDAQ is falling hard, I don't really want to take a long position in any of my trading stocks. I'll wait, because chances are this might break support and run down. It increases the probability of my trade when I trade in the same direction of the market. Let's see, John, let me answer your question. Am I recording this? Yes, John, I am. It should be uploaded. I'll process it after we finish here. Okay. Do I watch the ticks? Ron, usually I don't, because I'm watching 3 different trading stocks, 2 different time frames, and I'm watching the NASDAQ at the same time, looking for setups. Do I wait for the squeeze? No, I don't use the squeeze. Yeah, I don't use the squeeze indicator down here. When you say, am I watching it? Yeah, I use it as a directional sort of thing. Are the histograms going down or are the histograms going up? Okay, if it's going up, that's the direction. Also gives me the okay to trade in. It's pretty cool, because later on I'll show you an example of a divergence, and sometimes the squeeze is already heading in that direction before the prices fall. Okay, yeah, the cues. Usually when I watch in the room, I'm watching the futures. It doesn't matter. I just want to see which way it's going and how fast. Yeah, big winners, small losers. Yep, John. Personally, I prefer small winners, big winners, very, very few losers. Okay. All right. All right, next is the third type, is I'm looking for divergences. Now, usually this occurs either if it makes a double top at the open right after the gap and then goes to fill the gap, or later on in the morning, maybe 20, 30, 40 minutes into the day. This is a good example of a bearish divergence. Here's the first high. Here's the histogram bars. Here's the second high right here. Oops, I'm sorry, my bad. This is wrong. All right, here's the first high right here. Look at the upside momentum here. Okay, very strong upside momentum reflected in higher prices. Here's the next move higher, significantly overvalued. See how the prices are actually higher? Look at this histogram profile. It's a lot smaller in height. Okay, this indicator line, which is up here, is actually down below the 25 level here. Price is going higher, momentum is going lower. That's a divergence. Right in here, you can buy puts, and this falls. Now, this is, you don't normally get moves like this, but every once in a while, you'll hit the nail on the head, and boom. This is a strong fall. Depending on where you take your profits, you can buy puts right up here, moderately overvalued. You can sell some here at significantly undervalued. You could sell some here at the MQ trend dots. You can hold it until the indicator line goes flat right here, which would be down here. Which one would I prefer? I do all three. I sell some here, and sell some here. Okay, I don't have to get 100% of this entire move, because when you're trading, you don't know how far down that's going to go. Mary, that's a good question. It depends. What I'm doing is I'm trying to always gauge. Once I'm in the trade and it starts to work my way, what I'm looking at is previous levels of support and resistance. Okay, this low here to this low here. MQ trend dots right here. Okay, here basically I'm watching a change in momentum according to the indicator line. Okay, as long as this indicator line, this blue indicator line, is going down, has a negative slope, I can stay in the trade. Once it go flat like this, I'll get out. Okay, see how the slope is right here. I can even say, okay, once this squeeze histogram goes flat like this is a good one to get out of here. Okay, it's all subjective, and the nice thing about a move like this, there is no wrong place to take your money. Okay, if you say that this is good for me and that's a reasonable area where it's going to bounce, then that's fine. If you leave one on and it continues lower, good, that works out too. But what matters is you didn't lose anything on the trade. Yeah, this MQ momentum indicator, I love it too. It definitely, there's so much information I can glean from this. Okay, this line, the slope, the size of the histograms, the relative heights between them, and then price right here. Value is very important. Let you know if it's really moving. A lot of different things. Okay. Oh, you should, Mary. You should. Is this completely different from fading the gap? No, not really, Naga. This is later. The gap occurred here. See, there's no gap today in Google. Lots of times it's like that. No gap. But here's the follow-on move right here, and then we pushed higher here, and then bearish divergence, this high, and boom, it falls. Okay? Okay. So now I've showed you those three. We usually see them every day in the room. Well, I wouldn't say every single day, because sometimes there's no gaps. Sometimes there's a gap, you don't want to touch it. Okay? It just depends on the experience. Now here's Apple on a 250 tick bar chart. See the gap here to here? Okay? Now, there are times when, the gaps of the trades that I've showed you occurred usually within a few minutes to 30 minutes to the open. Now, let's just say, hey, what happens within that? This is the first hour of trading in Apple. Okay? Well, this is basically what I can show you and kind of pull it all together. This move right here, this first move, this is fading the opening move. Then Apple goes sideways. It can't break through this support level, and what's it do? It has like basically a cascade trade down here. This is a little different than and it's not on one of the three trades I showed you, but occasionally you'll see that kind of trade. Basically, it's a breakthrough the lows here, break through these MQ trend dots, and then it falls. Okay, that's a cascade trade off resistance. Then we have this low compared to this low. So what we have here, bearish divergence, a move higher, so make money here. We bounce along sideways within this channel. Okay, we break support here. Here's another fall right there. We fall, we bounce, we make this low, we make this low. There's a bullish divergence. Well, actually, it's a double bullish divergence, and then we move higher. Okay, all within the first hour. So we have 1, 2, 3, 4, 5 trades. Okay, I'll show you something that's really, really cool. So how many trades? 5 trades. Do you see where we closed yesterday? Right there. Do you see where we end the opening hour? Right there. We closed at 5:30. After the first hour, we're sitting at 5:30. The local business news people on the radio will say, my goodness, we've been at this an hour and we really haven't moved. That's what they'll say. And you're like, that's kind of funny, because we made 1, 2, 3, 4, 5 trades and they were all profitable. So I'll take a stock that doesn't move at all. Okay. but this is just not mean to be too sassy about it. It's there. This is my way of saying there are always opportunities to trade, and if you miss one of these trades, don't worry. There's going to be some more coming on later. Okay. Again, we keep an eye on the market, and then we keep an eye on the underlying. Again, we primarily trade Apple, Google, and Amazon. Apple and Google provide you more than enough opportunities. If I can get 2-3 good setups in each of these every morning, there's multiple opportunities to make money. Yes, Valerie, this is value charts and MQ momentum. Those are our value charts indicators. It helps us gauge how far and how fast the valuations are, and how the momentum, MQ momentum helps us gauge how quickly prices are moving in one direction or the other. Okay. If you want, Valerie, you could always look at the recording later on because there's a lot of good information there. Okay. Now let me show you a couple of really quick live examples, and we'll go to that because you'll probably say, Dave, I've seen some of these before. Kind of cherry, are you cherry picking? All right. Now, just like I showed you earlier, these are our intraday charts, and I got compressed there some reason. All right. Those of you in the room very familiar with it. Okay. Now I can't draw lines like before, but if you just watch my cursor, here's Apple. This is today. Here's the gap up. You've had a first move higher, second move higher. This can actually be considered a bullish divergence. Here's the first move. Here's the second move. You see right here? See that little dot? That's a green dot on MQ momentum. This is the high right where the arrow is. You could have faded this move. Okay, we partially filled to here, significantly undervalued, and then we fall a little bit more. Right here, this move from 507 down to 504, it's a $3 move right there. Potentially you can earn $200 a contract right there, that move. All right. Only reason why I put an arrow there is it's just a little easier for me to find. I think there was another one. Oh, that's a fading the opening move type trade, and you can see it did continue down, but that's the first move I saw. Next, if I'm looking at the Apple, again, this is at roughly 10 o'clock. We have here's that same move. This is a 125 tick bar chart. Here's that move I just showed you earlier, and it continued down. We continue going. We make this new high. What happens at this high? Well, we first have first high, second high, third high. This is a double bearish divergence. Here's the first move, and here's the divergence. Here's the second move, high, third move higher, and then we fall right here. This is another divergence from 507 and 3/4 down to here 506. That's a $1.75 move right there. And then once we finish that, we see this low, we come back up, we come back down again. You see how the MQ trend dots provide support? Compare this low, these histogram bars right here, to this low, moderately undervalued. You see the histogram bars here, almost non-existent, and we bounce higher. If you hold it through here, you went from 506 1/4 up to here 507 1/2. That's another $1.25. It's almost like you're profiting in the same by going back and forth in the same price range. We made $1.75 here, we made $1.50 here. Okay, it didn't go anywhere. Okay, it was up here, and moved down here, and moved back up here. So you profited here, and you profited here. It's just a bullish divergence off of this support level. Okay, value charts really, I'm not here to sell it to you. Okay, I'm just telling you it's a real tool that you can use. I actually bought value charts before I worked for the company. Okay, I use it. I can't read this chart without it. But so here's first moderately undervalued, we come back up, second moderately undervalued, and then a move higher. Okay? that right there is a bearish divergence. This here is a bullish divergence. Okay, and again, from this move here, this is at 10 o'clock, to this move here, when we pop back up here, this is 10:12. 12 minutes, potentially earning $250 per contract. Half of it here, half of it here. Okay, if you trade 2 contracts, that's a $500 day. Is that enough for you? And then here is the last one I want to bring up. If you're watching Google a little bit later on, maybe you're getting ready for lunch, Google's basically chopping sideways. In this sideways channel, we break lower, hit this support level right around 1144. It's almost exactly what I showed you in Apple. It's a different time frame. Here's the first low. See the histogram bars here? Okay, here's this low here. Pop up, came back down, hit moderately undervalued, again using value bars. Here to here. Look at the histogram bars. A little different. Almost not there. From here to here, you go long. If you just take this yellow move to yellow move here, okay, we're here 1145, and then it moves up here 1147. That's a $2.50 move. If you continue to hold it, and even through this pullback, you could have gone from 1145 up here to 1151. Okay, that right there is a $6 move, which is roughly $550 a contract right here. Okay, that 2 contracts, that's $1,000 right there. Okay, and that move started at 1219 and it ended at 1250. Okay, so this is a little bit longer because this is lunch. Ron, why did I use these particular tick values? Is because on a regular, quote, regular day, the bar formation is nice and steady. Okay, it doesn't, and also the bars provide very good even trading, except maybe when there's just the choppiness like this, but the majority of the time you get nice bars that make very nice formations like this. That's a trial and error thing. That's for me trading Apple, Google, and Amazon roughly 8 months now. 8 months intraday. Okay, almost every single trading day, 8 months trading the same stocks. That's why I know those numbers work well. Now, if Apple or if one of these has its earning report, I can upscale this maybe to 300, 350 because it moves much faster. Okay. Yeah, you can, but you can always scale it a little differently. I know TOS has a minimum size ticks of 133. You could trade on 133 in Google and Amazon, and then maybe like a higher, and then a higher time frame like 200. If you don't have ticks, you could probably use a 1 to 2 minute, 1 to 2 minute bars would be okay. Yeah, the thing about it is it's not a magical thing. It's what I'm used to, and I know it works well. But I can also trade this on a 1 minute chart. I'll show you. Let's just pick one here. Apple. Oh, that was Tesla. Now, someone asked me about the gaps in different chart. I'm going to do this really quickly, and then I'll answer some questions. Okay, here's that gap move, and it fell. Let's see if the divergence is there. They're going to look differently. Here's the first move higher. Do you see how this high here, nearly equally high? See how we didn't even get to moderately overvalued? Not even into the green, and the thing just fell. Sometimes it's a little bit more difficult to find them. Here's yeah, see the time frame's a little bit tighter. The divergences appear a little differently. And you can see there's probably not as many, especially right here. This is lunch. Let me see if Google, because it trades slower, the chart should be more closely aligned to the, here, this low. See the histogram profile? There's that low again. Same moderately undervalued. See the little tiny dot? Then we shoot higher. Okay, right there. Okay, this is one reason too. Well, some people said, well, this is a little fast. I said, okay, then you can trade a 5-minute, a 5-minute chart. Just don't expect to find as many divergences. But this move from this high to this high, there, right there, from there to there, and then it falls. See how there's no upside momentum here? There's no upside momentum, and then it just breaks and falls. I use shorter term time frames to help my timing to get in and out, but the divergences still show up there. Okay. And again, let's see. Let's just jump to something random like Priceline. Okay. Here's the first high. Here's the second high right here. From first high to second high. See the divergence? Buy puts at yellow, sell puts at yellow. I like to do it when it's going in. If the market is falling at this point, I'm more likely to take this put position and watch it fall. Okay. Let's see if there's any more. Sometimes if you get one that kind of gaps and just stays up there, it's hard to trade. I think LinkedIn will probably be one. No, it does move. You just have to be a little careful, because sometimes you'll get into price action like this. It doesn't really move. It's all sideways. This is all at lunch. But this is the movement. This is an example of movement, but there's no firm setup here. So you don't get a trade today in LinkedIn from the open. CMG. Here. Question is, do we need a separate trading platform like TOS to use with value chart software? Depends on what you use now, Valerie. Yeah, you do need a trading platform. TOS the value charts is available for TOS, TradeStation, several others. Valerie, are those bars more accurate than candlesticks? Well, actually, I read I read open, high, low, close bar charts like candlesticks. I just can see the candlestick pattern with it. If I'm always comparing the open and the close, like this. This is what we call a yellow jacket doji. Thomas Wood, who does our futures room, has basically combined both candlestick patterns and value charts, value bars more specifically, and right there. We have pretty cool names for our trades. I mean our candlestick patterns. You know, you might have a shooting star. Well, we'll have a yellow hat shooting star. Or this is normally called a doji. See, the open and close is exactly the same. Well, we call that a yellow jacket doji. And by combining value and the candlestick pattern, it's actually it increases the probability of a candlestick reversal being successful. Okay, so honestly, the next time Thomas offers his value candlestick course, if you haven't taken it and you have an interest in candlesticks, there's absolutely nothing that should keep you from taking that course. I was in the first class he ever offered that in, and I still use that today. Okay, let me just see here. You've never traded options. Aren't the spreads scary for Mary? Before you trade options, you need to be careful. There are a lot of opportunities with options, but it's like a power tool. It's like a drill or a saw. You can do a tremendous amount of work, but it is they're dangerous if you don't know how to use them. Tomorrow I'm having my there's a workshop. I'm going to tell, because some people are getting ready to go. Just to let you know, I have this with Mark. It's weekly power option weekly power option strategies with live trading, and I'm going to review some fundamentals of options trading. It's not as full featured as my core options course, but it definitely talks. We're going to talk about the components of options pricing, time decay, the difference between credit and debit spreads, things like that. So